The S&P 500 closed out the week with another all-time high, something we've also seen for the Dow. Markets are looking very overvalued, and that's something that everyone seems to believe. What we aren't seeing though is the same from institutions. In fact, whilst they may be buying, it is to a much lower degree. And when we zoom out to look at not just the latest data, but also to see what are institutions and hedge funds doing in comparison to retail, well, if we look at the most recent data, we can see July, June, and on a trailing 12-month average, institutions are selling. Hedge funds, well, they're also doing the same. In the latest month of data, they're selling, and on a 12-month average, again, a very similar scenario. What we're seeing though, retail continue to buy, yet institutions continue to dump. We're not just talking a million or two, we're talking billions and billions of dollars in very well-known names. And our focus in today's episode is going to be on what members of Congress are doing, and they too, like institutions, are selling millions and millions of shares in some very well-known names. We've in fact gone through some of the latest data to highlight the key trends as well as themes of companies they're selling to really explain in this episode where they've been dumping. And it may actually be good news for those investors who believe members of Congress should be banned from investing, as it is something that is on President Trump's radar, which, if you remember from our previous episode, we highlighted that the penalty for insider trading from members of Congress is a whopping $200. Now, as it mentions here, it isn't really an impactful deterrent, wouldn't stop these members of Congress who are making millions and millions of dollars to stop. And we always like to highlight one of the most popular, well-known. She is by no means, in fact, the best member of Congress, but if we're seeing them outperform and significantly against the S&P, for example, in the last 10 years, Pelosi is up 745% versus the S&P's 242. It is extremely likely that she has some kind of edge, given this is also a massive outperformance of Warren Buffett, Berkshire Hathaway, who is considered one of the best investors today. And just to reflect, as we said, it isn't just Nancy Pelosi that massively outperforms. If we look at 2024 data, we can see some triple digit. We have David Rouser in number one place. 2023, again, similar scenario. Brian Higgins up 239% when the S&P itself was 25. And 2022, in fact, if you want to go back, the data is there. You just need to search it. Members of Congress, more often than not, massively outperform. That's why today we're looking at 8 stocks they've been dumping, including number one, Novo Nordisk. We're going to give a brief analysis of the company, our own evaluation, and whether we actually believe these are ones we should be buying rather than selling. Now, we've covered this company in quite some detail, so I'm sure you're aware why they've had a lot of trouble overall, but just recently they reported their earnings where, in fact, even with some of the copycat issues they disclosed, their sales were looking very promising. And just days ago, we saw that they got US approval for liver disease, which actually, after the market close on Friday, highlights that investors are liking this. It's up 7%. So this is the first one they've been dumping. As we can see, down 62% in the last year. Year to date, down an incredible 39%. Over the last 10 years, they've now underperformed the S&P, up 91%. In fact, if we look from a year ago today, around that, the company peaked around $145. Since then, on a downward trend, now nearly 52-week low, with just one singular buy rating from Seeking Alpha. Wall Street, whilst they don't say a sell like we see from members of Congress, they believe right now it is a hold. And if we look at the forward P ratio of 13.2, that is considerably below their 5-year average of 30. Typically, straight off the bat, we would call this a severe undervaluation signal. But remember, we never look at valuation in pure isolation. And we can see the yield 3.3%, one of the highest it has offered in the last 5 years, well above their 5-year average at 1.4. And couple that with the blue tunnel methodology, which within the parameters highlights the intrinsic price, we can see huge disparity between where it sits today and even the bottom end. That is a severe undervaluation signal, one that's only been increasing from the beginning of 2025. So could look like a good opportunity. Members of Congress Don't believe so. And actually, when we zoom out to the last 5 years, you would never have been able to buy this in an undervalued position until the beginning of the year, really highlighting more often than not Novo Nordisk trades at a hefty premium. And if we look at their growth, which comes in at a D-, is actually not too bad when you see year on year revenue was up 21%, expected this year at 18%. That is well above the sector in the mid to high single digit, and also they're increasing at a marginally faster rate than their own 5 years. One thing that lets them down though is their EPS, only projected to grow 7.5% in the next 3 to 5 years, when, as we can see, the sector sits higher at 11, and so does their 5-year of 15. And in the next 2 quarters, they are anticipating growth, although around the mid to high single digit. They have a 100% track record in the last 4 quarters, where at a bare minimum, they've either been in line or beat, which is great to see, with projected next full accounting period trading at a forward valuation just above 13. We'll also reflect individually what institutions are doing with these stocks. Novo Nordisk, 12% ownership. They've been selling $6 billion in the last year, buying a little bit more at $7 billion, but we actually notice nearly twice as much buying in Q2 than selling, so it looks like institutions have been buying the dip, although worth flagging in the previous quarter they actually were net sellers, so definitely something worth considering. And with each one we will show you our intrinsic price. Now Novo Nordisk, $53 derived from the DCF model. First thing we would say, reason why this is lower than maybe previous episodes, they lowered their guidance in their latest earnings, so future free cash flow sits at 6.5 billion as opposed to their initial 10 billion. But what we'll do for your interest, we'll highlight the valuation on both the updated guidance as well as the previous. So we've got a growth rate of 14%, low, medium, and high, 12, 14, 16. As always, numbers here are subjective. You can grab a copy of this exact model by clicking on the pinned comment below, running through your own numbers, whether it's for Novo Nordisk or any others. Also worth mentioning, baked in right now to these numbers is 15% growth over the longer term. So if you see this as way too high already, you'll believe the company's overvalued. If you see it as way too low for the growth stock, then undervaluation. So growth at 14%, discount rate at 8, we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving us $53, which actually indicates downside of 5%. We'll also flag for those that want to see for consistency and transparency, at 12%, 46, downside of 18, at 16, you can see $60, upside of 7. Now, typically what we like to do is use the middle rate where we go through to the next slide to highlight the margin of safety. Given intrinsic price is at 53, current value after hours is higher at 56. This is saying there is a 6.4% premium on the current value. Now, if you're someone that wants 10%, we would kick that off usually if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Then a buy at $47, at 20% a buy at $42, and at 25 a buy at $39. Right now though, Novo Nordisk a premium of 6%. Wall Street, they continue to lower their price target. They don't have it as a buy anymore. $67 into next year, 20% upside. Let us know, are you siding more with members of Congress seeing this as a sell, or maybe one to actually buy the dip? And as we said, we'll also highlight using the previous guidance for those that believe they can get back up to that level in the next year. At the same middle rate of 14%, we get an intrinsic price of $82, indicating 46% upside. Baked in on this higher future free cash flow, we see 8%. So using 14%, we now get a margin of safety very high of 32%, and that is highlighting here if they can hit their previous guidance, then there is a much more significant MOS. We'll also factor in, just so you can see, as it will pull through automatically, using a 12% where we get $72, upside of 29, there is a 23% margin of safety. Let us know your thoughts on number 1, members of Congress have been dumping Novo Nordisk, buy, hold, or avoid. Before we move on, just to let you know, we have released our latest free weekly article. We draw on every single Monday morning to your inbox, covering severely undervalued stocks as well as what's going on in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of August, lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet released last week detailing 29 stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next company we're moving on to is American Express that they've been dumping, up 22% in the last year. Year to date, it's up 3%, so underperforming the S&P, but over the last 10, outperformance up nearly 300%. It's also trading near 52-week high, just one buy rating from Wall Street, but very weak at 3.55. 3.5 is what would flip to this buy rating, and we can see the forward valuation of 19 is above the 5-year of 18, with a yield lower 1.1 versus 1.2. Both of these signals give rise to a possible overvaluation. Yet when we look at the blue tunnel, first thing we notice is that it is increasing, which is always great, but it's right there at the upper end. So another question around possible overvaluation. You could have bought this one during the liberation period in a severely undervalued point. Over the last 5 years though, as very obviously detailed here, this one has been incredibly difficult to get into any undervaluation point. So make sure you are subscribed, notification bell is on. We will flag when there are strong undervalued opportunities. And a growth at a B where year on year 9% expected the same this year. That is above the sector and only slightly below their 5-year average at around the 10% point, with EPS looking better than the sector, unlike what we saw from Novo Nordisk, 14%, sector itself at 10%, but their own 5-year highlights, they were growing much faster at 21%, and nice to see growth expected over the next 4 quarters. They have a 75% track record, 3 out of 4 beats, last 2 were nice sizable ones at that, with projected forward PE into next year below 18. And institutions with their 84% ownership sold 12 billion. They bought a lot more at 19. They continue to buy a lot more in the most recent quarter, in fact around twice as much, and they've been net buyers for quite some time, although Q2 we can see the reversal in 2024. In our intrinsic price at $325 gives rise, as we can see here, to a 6% MOS. So not a lot, because as always we do want 10% at a bare minimum, which would be a buy at 292 if it met the criteria, at 20% at 260, and at 25 244. Wall Street themselves see very limited upside, which is probably why we got the weaker buy rating, 332, only 8%. So let us know, likewise with American Express, where it sits in the buy, hold or avoid. Maybe you agree with members of Congress, maybe you don't. We'll also flag as well, baked into the numbers if you solely want to look at a DCF, is 2.6%. So if you straight off the bat, as we said, think that's way too low, then this could be one to potentially consider. The next stock they've been dumping is Microsoft, which is actually the second company now to sit in the 4 trillion club, sitting right behind Nvidia, and it's also one that's not only booming due to artificial intelligence, but they're also maintaining growth in their other income streams. Now it's up 24% in the last year, year to date up 24% as well. Over the last 10, massive outperformance of the S&P, up more than 1,100%, sitting very near, in fact, as we can see, to its all-time high of $555. Strong buy from Wall Street, a buy from Seeking Alpha. Yet, like American Express, we get a double possible overvaluation signal. Forward PE 34 versus 32. Yield lower at 0.6 versus 0.8, and we also notice again very similar, sitting right there at the upper end. Again, liberation period was another time you could have bought this in an undervalued level. Over the last 5 years, again, high quality companies like Microsoft very rarely show up as a severely undervalued position, and the growth comes in at a D+, yet year on year and expected this year at around 15%, well above the sector in the mid to high single digit, slightly faster than their own 5-year, although we're talking not even a percentage, and EPS projected growth 11 to 12%, actually not looking too good given the sector sits higher at 15 and their own historical higher at 13.5. But as you would expect with this very consistent company, green across the board, 100% historical track record, double-digit growth over the next 4 quarters, trading next full accounting period at a forward P of 29. And institutions, fairly low ownership if you do look at other Mag 7 at 71%, 111 billion selling, pretty much triple the buys, that is huge at 352 billion, and a massive buy in Q2. They are really net buyers here and by quite some way. Reversal of the trend, you'd have to go Q1 2024. Now our intrinsic price at $436 straight off the bat highlights it's trading at a premium near 20%, but bear in mind this is using 14%, which has been their average over the last 10 years. If you wanted a medium, you're still looking at downside. 18% is where upside would show up. Reverse DCF 16.5% is baked in to the current numbers. So for those that believe these are reasonable projections, well, at 10% a buy at 392, at 20% a buy at 348, and at 25 around 327. Wall Street, they see this going even higher, $624 into next year, 20% upside. Let us know your thoughts, but we can also reflect at the middle 16%, which is typically what we would use for most of these companies. MOS, now you are seeing here a slightly smaller premium of 4%. Those wanting 10, a buy at 451, at 20% at 401, and at 25, 376. Let us know your views on Microsoft. Is it one now to consider trimming? Members of Congress have been doing exactly that. We then move on to one that has close ties to Las Vegas, where in fact the tourist-dependent destination is having a very slow year, and that is the REIT Vici Properties, where it's up 2% over the last 12 months. Year to date, double digit, 11.3. Over the last 5 years though, sitting at around 40, trading at the upper end of the 52-week range. Members of Congress, whilst they have been dumping, Quant give it a strong buy, Seeking Alpha give it a buy, Wall Street's buy 4.47, very close to 4.5 to flip into a strong buy as well. And this one is showing slight signs of undervaluation with a forward P to AFFO, price to adjusted funds from operation, below historical 14.4 and a yield slightly higher 5.32 versus 5.12. And that's also a similar story here, sitting right there towards the lower end, but again, not that often where we see a true undervalued point. Over the last 5 years though, there was a time in 2023, right at the back end, and in mid-2024, where you could have added this at a very hefty undervalued signal. And growth looking very impressive for a REIT at an A. We're talking historically over the last 3 and the last 5 years around the 8 to 9%, which is well above the sector, so it is a very strong grower. In comparison, projected 4% in the next 12 months, again above the sector at 2.5. Nice to see factor grades looking all very strong and green. With 3 of the next 4 quarters projected growth, only a 50% track record though, bear that in mind. Most recent one was a beat, and forward P to FFO expected to come down slightly into next year. Now institutions, 98% ownership, 2.3 billion selling, bought more than double that, and they've done that as well in Q2, so continue to be net buyers. In fact, if you want to see the reverse of the trend, well, you'd have to go back before Q2 2022, so definitely they are very, very bullish. And our intrinsic value at $38 does give rise to a margin of safety of 15%. If you wanted this one at the 20% level, a buy at 31, and at 25, 29. Wall Street, whilst there is a near a strong buy rating, there is limited upside of 12%, but the yield is very high. We're talking above 5%. So where do you sit? More towards members of Congress? Is it worth selling the REIT? Or actually, like institutions, they've been loading up. We then move on to Broadcom, a company that continues to perform very, very strongly. However, the main issue with this one is the valuation, which is extremely obvious, is sky high. Members of Congress have now been dumping hard, and it's up 84% in the last year. Year to date, up 32%. Over the last 10, huge outperformance of the S&P, up 2,649%, trading very near all-time highs of $317. Strong buy from Wall Street and a buy from Seeking Alpha. Yet just look at the forward valuation, 42, well above the 5-year of 18. yield 0.77, well below the 5-year of 2.8, and it couldn't be more obvious. Based on these, it looks incredibly overvalued. The disparity between where this company is and even the upper end of the blue tunnel, which yes is rising over the last year, but it looks to be sky high as we just saw. And over the last 5 years, if you want this pretty much in a reasonable valuation, you'd have to go back over 2 years ago to mid 2023. Now growth is strong, B+, year on year 34%. Over the next 12 months, projected 28, which on all accounts against the sector and their 5-year average, they're growing much faster. Earnings per share, that conclusion remains 23% versus 15 and 16, and they're projecting double-digit growth over the next 400% historical track record. But even if they hit their EPS for the next full year, the forward P still looking high, is expected to come down to 37.2, where institutions with their 76% ownership selling 45 billion have bought a ton more, 253 billion. They've bought more in Q2 as well. So they look to be very bullish on this, yet members of Congress are selling, and our intrinsic price of $258 means you are paying a 19% premium today. Even Wall Street, which is weird with their strong buy rating, on average see this at $306, which means no upside whatsoever. Baked into the numbers as well, based on the DCF, is 22.4%. If you believe there is upside, well, you'd have to see at least a 25% growth rate, which comes to 367 and 20%. So using the middle rate, as we can note here, at 20%, you are in fact paying a near 20% premium. Broadcom, let us know, buy, hold, or avoid. The next one they've been selling is Eli Lilly. Now remember, we covered this in detail not that long ago. Shares were down, their weight loss pill didn't live up to expectations from analysts in terms of the weight loss, and it's down 25% in the last year. Year to date, down around 9%, but over the last 10, like most today, significantly outperforming the S&P, up 730%. Trading near 52-week lows. Remember, we covered this. 7 different insiders have been loading up towards the bottom, and we get a double buy from Seeking Alpha and Wall Street, and we get a forward valuation of 26, well below 5-year of 38, although the yield is still lower at 0.9 than the historical 1.2. Nice to see though, we get here in fact disparity on the bottom end, undervaluation, as the blue tunnel does continue to increase, yet the share price is seeing the opposite effect. That is where we always say opportunities lie. And if we zoom out to the last 5 years, this is one again very similar to Novo Nordisk, where it hasn't in the 5-year period until 2025 given investors to consider at a severely undervalued level. Now growth comes in at an A+, we're talking year on year 37%, forward looking 29%, well above the sector. Is also a company that's been growing faster than their own 5-year average, and the same projected for the EPS, 32%, when sector sits lower at 11, and even their own 5-year much lower at 22, with 3 of the next 4 quarters being double-digit growth, projected next quarter triple-digit. However, they have a 50% track record. Nice to see though, most recent quarter was a beat. Projected forward P next full accounting period 23.1, and institutions with their 83% ownership selling 90 billion, they've bought nearly twice as much at 150, but we really should flag this most recent quarter. Institutions, like in fact members of Congress, have been dumping a lot more. In our intrinsic price at 691, pretty much telling right now, if you believe these projections, you are paying a very minimal premium of 2%. Wall Street see this 938 into next year, 33% upside, and we have used a growth rate of 35%. Now as of today, baked into the growth is 35.3%. So if you see this at 40, that is in fact lower than their 10-year average, giving rise to 958, which actually isn't too dissimilar from Wall Street's forecasted value, meaning that is the growth level or thereabouts that they see, which gives rise to a 27% margin of safety. Let us know your thoughts on Eli Lilly below. The next stock they've been dumping, and one they've been doing for quite some time now, as it does keep reappearing in these episodes, is Visa, which as you remember did take a bit of a hit, although fairly marginal, given we were hearing around stablecoins and how that would hugely affect the company. Well, it's still up 29% in the last year, year to date up 9%. Over the last 10, outperforming the S&P to a lower degree than from what we've seen other companies today, trading at the upper end of the 52-week range, Double buy from Seeking Alpha in Wall Street, where actually the forward valuation and the yield aren't too dissimilar from the 5-year average, indicating possible reasonable signal. And that's also reflected when we take a look at the blue tunnel, pretty much a reasonable signal throughout the last 12 months. And over the last 5 years, it is a little bit of a different story. There were time frames where you could have bought this in a severely undervalued level, and we would say a fairly consistent company, around 11% last year and expected this year, above the sector, which is in the 7% range, but as we said, very consistent, pretty much the same numbers over the last 5. EPS projected 13%, that is above the sector at 10, but lower than their historical 16, and green right across the board as we would expect from Visa, with the projected forward P sitting below 27 over the next year if they can hit that EPS target. And institutions with their 82% ownership selling 41 billion, they bought about 50% more at 65, bought twice as much in Q2, so actually unlike members of Congress who continue to sell month on month, quarter on quarter, institutions have, at least in the most recent period, been buying a lot more. Now, our intrinsic value, $350, gives rise, as we can note, to a very small MOS of 2%. Wall Street see 405 into next year, 18% upside, with, as we can see, 12% growth baked in as of today. So using 12%, you will get a margin of safety of 10% if you add around the 314 level, at 20%, 279, and at 25, 262. Now, given Wall Street see this at 405, they're pretty much saying their projections have 14% growth, as that gives the intrinsic value not too dissimilar, meaning you're getting a 15% MOS. For those that believe this but want a larger one, at 20, a buy at 322. So let us know your views on Visa. We then move on to ASML, which they continue to dump, and this one didn't have the greatest earnings commentary, where we heard there was a bit of uncertainty with their growth, and there was no guarantee that we would see any growth in fact into 2026. And it's been hit down 20% in the last year, year to date up 7%, over the last 10, outperforming once again, up 764%, trading towards the lower end of the 52-week range, a fairly rare triple buy rating right across the board, where we get a double undervaluation signal, forward P 27 versus 33, yield bang on 1 versus 0.84, and we can also see it does sit slightly outside the bottom end, but this one pretty much in the last year, you could have bought this any day in an undervalued level, something that is fairly rare to see when we zoom out to the last 5 years. And their growth coming in as C, remember, cyclical industry, last year 26%, projected 10 this year. Now both accounts still above the sector, but actually a little bit lower than in fact their own 5-year at 16.4. In terms of EPS, 17%, that is above the sector, although just about at 15, but again, slower than their 5-year. EPS also only projecting 2 of the next 4 quarters to be growth, 100% track record, most recent one, very sizable beat, trading on 2026, forward valuation below 25. And the institutions, 26% ownership on the lower side, actually sold a little bit more than they bought in the last year, and that's also reflective in Q2, so they have for the large part actually been net sellers. Now our intrinsic value, $909, gives rise to a very attractive 19% MOS. Wall Street continue to lower price targets, but still with their buy rating see 19% into next year, $880 price target. Now if we look at 25%, then possibly a buy at $681, and that is using a 12% growth rate, where we see baked in as of today is 9.1. If you want to be even more conservative and go for 10%, well, you are still getting a MOS, but it is much lower at 6. If you wanted 15, a buy at 671. If you wanted 25, just under $600. So let us know, ASML as well as others today, whether you agree with members of Congress or actually you see these as undervalued opportunities. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.